Pubmatic stock is down about 33% after they've announced their recent quarter results. Currently, it's trading at about $12.3. In this video, I'm going to talk about whether this is a buying opportunity. Pubmatic is an ad tech company. Previously, I've done a video about Pubmatic few months ago. I'm going to keep the link in the pinned comments. I'm not going to repeat too much information from that video because I want to keep this video short. In order to determine whether this is an opportunity, we have to first look at why the stock is down. As you can see on the screen, in the most recent quarter, they made about $63.3 million of revenue. A year ago, in the same quarter, they made about $63 million. So that's flat growth, almost no growth year over year. And look at the GAAP net income. It's negative $5.7 million. So they made a loss. Let's now look at the income statement to see what really happened. As you can see on the screen, they made about $63 million of revenue in the most recent quarter. The gross profit is about $38 million. So that's about 60% gross margin, which is healthy. Look at the operating expenses. They are about $45 million. Now look at the general and administrative expense. It increased from about $11 million to about $18 million year over year, and that has contributed to the operating loss of about $7 million. The operating loss is about $7 million, right? So the net loss should be equal to or more than that. But in this case, they have interest income of about $2.1 million. So in the absence of that interest income, the loss would have been even more. Finally, the EPS was about negative 11 cents, and just over a year ago, they posted positive 15 cents. So that's a huge difference in the EPS, and that has definitely upset the investors. The share count is in the $50 million range, and they have not diluted the shareholders significantly. So based on the earnings, we can conclude that the revenue growth is flat and the loss has widened when compared to the past year. It's definitely not good. In addition, they're saying they can only make anywhere between $58 million and $61 million in the next quarter, and that's actually negative growth year over year. Pubmatic is blaming it on the macroeconomic conditions, but if this company has any moat or its products have any edge over their competitors, the growth should have been more than their competitors, right? So that's definitely not happening. It means that Pubmatic's products have no moat. The forward guidance is not impressive, obviously, and that has upset the investors as well. Let's look at its balance sheet. As you can see on the screen, the total assets are about $583 million and the total liabilities are $289 million. So the book value is about $294 million. But at the current price of about $12, the market cap of this company is more than $600 million. So with respect to book value of about $294 million, we're still looking at a 50% downside from here. Let me show you a valuation that I've shown in my previous video. I have estimated 10% year over year growth for this company. This year, their growth is either flat or slightly negative. But in the coming years, I'm estimating that the macroeconomic conditions will get better and advertising industry will recover and Pubmatic will start to grow again in the double digits. Based on that, I have estimated $412 million of revenue in 2027. With respect to net profit margin, I have assumed 20% based on their 60% gross margin, but we do know that last year they posted profit, but this year they posted loss, right? So the operating expenses are increasing, so we do not know if they can get those operating expenses down in the coming years and get to this 20% net profit margin. And I've assumed a 17.5 multiple with which this company would be worth about $26. The current price is about $13, right? So we're looking at a 2x, which is a very attractive gain in 5 years. But the problem is for companies like Pubmatic, which do not have a moat and which do not have control over their operating expenses, we need a little bit more factor of safety, maybe a 2.5 factor of safety. So if I apply that 2.5 safety factor to this $26 target price, when I back calculate, it comes down to $10. So I would be looking into Pubmatic stock if it falls below $10. And that's when I can take a risk because I'm looking at an attractive return. At the moment, I don't think this is an opportunity. I would stay away from the stock and I would look into it if it falls below $10. Let me know your thoughts in the comments. Thank you so much for watching.